Welcome, everybody, to the Investors Roundtable. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And we have an excellent panel for you guys. And I hope it will be excellent. I'm pretty sure it's going to be excellent. I hope going in every time, but I think this one, I'm fairly confident you guys will all really enjoy. Our topic today is identifying great companies early. We're going to be going through anecdotes, how each of our panelists have found them in their careers, and just some things to look for and or look out for. You might see some imposters out there that have are masking themselves as great companies early. So, we're going to go through all that today. And so, joining me today on this panel, a couple newbies that I've interviewed in the past on Planet MicroCap that I'm so excited are here today. To my bottom right, I guess it would be. I'm sure it's going to show up differently if you're watching this. Is a Sean Iddings. He said I should introduce him as an entrepreneur, but that's kind of like, you seeing the tip of the iceberg versus everything that happens beneath. So he's done a lot when it comes to MicroCap and really supporting the community over the years. So I'm so excited Sean is here. Sean, what's going on, man?
It's good to see you, Bobby, and glad to be on the show. I've watched it a bunch of times and really enjoy what you're doing. And I'm looking forward to chatting with the other guests today.
Oh, very cool. Very cool. Thanks, man. And also first time joining us, but recent interviewee on Planet MicroCap. He is known as the Batman Investor. He is the Alaska Permanent Fund by day, MicroCap Investor by night. Marcus Frampton. Marcus, how you doing today?
I'm doing great. That's an awesome nickname. So I appreciate it, Bobby.
Of course, man. You got it.
Bobby coined that one. I did not come up with that.
I can't even take full credit because our hosts on In the Market Trenches, they're also they have a similar mindset as well. So there's a lot of I guess if we had to have like the MicroCap verse, the multiverse of Batman investors, there's many of them. But Marcus, Batman investor, we'll do. You're Batman 661, right? I think that's what they refer to in the Marvel universe. Earth 661. I don't know. Anyways, so nerdy, but we're gonna get past that. Here we go. Also joining us, the vet of the Investors Roundtable crew, the man with many opinions, anecdotes, the full bit, an incredible selection of eyewear as well. We got Jason Hirschman. What's up, Jason? How you doing?
Hey, nice. Always pleasure to be here, Bobby. And I don't know if I can compete with Batman. And Sean is rocking the Clark Kent look today with his new glasses there. So, but I think he's going to pull open and reveal himself as Superman once he starts talking about the stories he has. So, pleasure to be here.
Very cool. Thanks for joining us. So, to get right into it, as I said at the top, our topic is identifying great companies early. I wanted to kick it off with Sean because Sean is also the co-author of one of my favorite books on investing, Intelligent Fanatics. Has worked with Ian closely on MicroCap Club over the years. And I know as a vast array of anecdotes, the whole bit. So Sean, let's start off with you. What would you say is core to you when you're looking to find great companies early?
It's a very good question, Bobby. And I think one of the things that I've learned throughout really anything that I've been doing, like I was really into music growing up. I went to school for that. So I've really seen how some of the great individuals there get there, but also how some people in that industry are able to find the next great individuals. But one of the things I think in business, a lot of people forget is that business is people, really. If you boil it down to the most basic essence. And I think with business, that's human. That's the thing that's really identifiable, right? So business, you have organizations, there's a lot of complexities around, what services are provided and how they're, people are able to create them or implement them to their customer. But the people aspect is one of the things that's really important and knowable. And I think for identifying super talented, companies early, you really have to look at super talented leaders really early on. And I think that's one of the things that you're able to actually identify earlier in a company is who's kind of the DNA of the company, that being the leader, and how are they trying to build what they're trying to build. And so learning to identify those super talented people before others is, I think, one of the most unique superpowers an investor can have, and it's totally underrated. And so that's one of the things that I've really tried to learn about, build some mental models around it, and then be able to utilize that, my pattern recognition system, to find these companies early, and then be able to not only find them early, which is, I'd say, rather the easy part, or easier part, and then be able to hold on to them through thick and thin. So I think that would be one of the things that I really think about when I'm trying to find, the next great company. And of course, I have a bunch of different examples that I wanted to give, but I'd like to hear some of the other guys' thoughts.
Yeah, that's a great way to kick it off. Marcus, Jason, same question. What's core to you in finding great companies early? Marcus first.
Well, I'll throw something out and then Jason can go. I mean, most of my investing in microcaps, I'm looking at companies kind of under 50 million market cap. So just starting there, and it's usually over the counter. So just starting there, you're already at a valuation that's lower than most early stage venture capital deals today in the market. Like, I don't know the exact number, but if you're doing a Series A or Series B from a major venture capital firm, you're probably at a pre-money valuation above 50 million at that point. Maybe the seed angel rounds were lower, but you're already at a very small company. So if things are going well, there's a lot of runway, and there's like the potential to uplist, and there's, and every business is different. If it's a retail concept, if you're at that size and the unit economics are working on the stores, you're by definition not, across the country. So there's tons of white space for any company of that size, but obviously it doesn't apply to every company. There's I mentioned before the conversation, a company I'm involved with that went public in the 50s, and its market cap was under $10 million for that whole period of time, which is kind of amazing. So it's not like a given that a company, and to be in business for 50 years, 70 years is you're by definition successful, but you're not growing rapidly. So I start with valuation, and I'm looking for companies that are small but trade at low multiples of cash flow. And then, like, the holy grail for me is when you have that combination with some upside event. Like, it could be a small industrial company that never will grow, but one that I invested in recently that I don't own at this point is Mechanical Technology, and it screened well. Like, on the base, they make some aerospace instruments and have like $1 million of EBITDA in a typical year. And I bought that last summer at 6-7 times EBITDA, and they have all these NOLs, and they decided to get into cryptocurrency mining, which I know nothing about. But it was a good investment in my opinion, not just off the base business. And then there's this upside that's hard to get your arms around that gives you some optionality. What I would love to hear from these guys about is how you stay in, because my mistake is I always sell when the margin of safety goes away. So anyone that's followed Mechanical Technology will know that it just rocketed up. Like, they bought some Bitcoin mining assets out of bankruptcy. That's now in vogue. They're, and the stock went from 75 to, I think today it's at 10 or 12. And so that's like, a 15 bagger. I participated from 75 to 3. I think these guys have maybe mastered the art of hanging on for the whole long run. But like, in summary, to me, I want to invest with a margin of safety, a low valuation. And then if there's some business plan that, could get you to 10X, you don't want to bank on that, but it's great if it's there.
Very cool. Thank you, Marcus. Jason?
Yeah, I think Marcus raises a number of interesting questions, and I don't think anyone really truly masters finding great companies early, right? All you really can hope for is finding literally just, maybe even less than a handful in an investing career, and hope that really has a remarkable effect on your net worth. And it's also just not only in finding them, but also holding on to them is a very difficult thing. And I'm sure we'll talk about, Expel, which, Sean and I own a little later on. But But on this, just a day or two ago, this company called Liat, which makes sort of bicycle and motocross accessories, reported, uh, and I own like 100 shares now. But literally a few years ago, I was a 13G investor. I had 353,000 shares, and I believe in management. I met them a few times. Believe that they're doing a great job, and for really stupid reasons in hindsight, and maybe some bad luck, uh, I sold my shares to get into another company called Hirschman, which doubled but then sold. Couldn't get back in because it's a nano cap, and it went from like $2.50 up to like 12. So that's like a $2 million mistake that I made, even though I was patient for a few years. So it's just something that, like, even if you have tremendous success, that you never truly master, and you're always, looking, you know, always looking to improve, and you're always at this, you're always going to make errors. So I guess you can't
So
take
what-
it personally,
yeah.
but you lose a couple.
I guess
million
Bobby
dollars,
has questions, but I have
you
a
do take
question
it little
because I'm trying to
personally.
figure out how to figure out when I get out of
Please
it.
jump
Are you
in.
saying that
Everybody
you-
jump in
So
whenever you
so
want.
you have your position, and then it's kind of a use of it's a highest and best use thing. Like I had other things I wanted to put my mechanical technology capital into, and that's part of why I got out. Is that kind of
Yeah, it's funny because with Liat, I was frustrated at the pace of their growth and distribution.
Yeah.
And and even when you do a post-mortem, right, and you're trying to figure out where did I make the mistake, it's really difficult to do, which is why I think partly it's so difficult to improve as an investor, right? Was I just unlucky in the fact that, like, doors, things really accelerated during COVID-19? Everybody suddenly wanted bicycle equipment. Everybody suddenly wanted to be outside and exercise. And they were always like, well, if we, the bicycle industry, the motocross industry was stagnant. They couldn't get into be like the third supplier. And suddenly everybody wanted another supplier, right? And they were like the next ball, next big thing. And so, how much is that a mistake on my part, and how much of just not believing that, and maybe these guys, they're such a great management team, they would have found a solution anyway if I gave them more time. So I think, it's so hard when you do make a mistake to figure out what's the true cause of it. And that's partly why it's so hard to improve as an investor.
Right, because it's not like you were wrong. You picked the right you picked the right companies. It was just that, and this is something we talk about all the time on here, is that the damn timing, and trying to understand when we want to get in or out, or you see another opportunity, and it's sometimes a very I call it the Hamletian effect.
I mean,
where,
yes, I mean it's exactly what you say. Very Hamletian effect,
The Hamletian
as you say.
brand new, everybody.
And it's
It's gonna
tough.
get stolen everywhere.
Yeah.
Yeah, right. Sorry, Jason, I cut you off. I'm sorry.
No. I was going to pass it on to Sean or Marcus, and I'm
Yeah.
sure they have some thoughts on war stories that they could share, and also just to get back on the how do you find those great companies?
Absolutely, Sean.
Well, I don't really have anything to add in terms of like opportunity costs and trying to learn from whatever mistakes. It's really hard to do in real time, and you just have to keep learning. But one thing that I wanted to bring up to you guys, just to hear your input, but one example that's really helped me to contextualize and really have this idea of finding talent early. And like I said before, that I think it's really hard to find a company, just a company. If you're zooming out and you're looking at an organization and trying to see if it's going to be the next 20, 30, 40, 100x, that's really hard to do. But like I said, I think one of the more identifiable pieces would be the human component of that, and especially looking at the leadership, because they create the programs and incentives and all the strategies and the vision to really get the whole organization and team going in the right direction. So the one example that I have is back in 1959, Columbia Records was having a really tough time trying to go away from like the jazz scene and classical. And the owner, what Goddard Lieberson or something like that, he decided to hire back an older gentleman. He's in his 50s now. His name, John Hammond. Now, John Hammond, he had this Midas touch for finding great musicians in his 20s. So, and we're talking jazz here in the 30s. So he found Billie Holiday. He found Aretha Franklin. He found Count Basie's orchestra. He found, just on and on and on. And if you don't know jazz, just think he was pretty much the Warren Buffett of jazz, finding the next great jazz player. And I think he's the perfect model for any of you investors trying to level up your game on finding great companies early, or boiling it back down to finding great leaders early. And the story goes on that he was hired in 1960 about, and you think this guy has no idea what the new music scene is, and if you go back to the 60s, it's more folk's music. But what did he do? So if you're going to bet on John Hammond, you wouldn't bet on him if you didn't know about him, because you think he's a 50-year-old crotchety guy who had a great track record. But no, if you really understood how Hammond thought and how he did, found these great artists early, is that when he was in his 20s, he was at every single jazz club in New York City. And there were stories, people saying if there was a broadcast, if there was a rehearsal, if there was anything happening to do with jazz, John Hammond was there. And so he knew everything. So now in 1961 or so, he doesn't know anything about the new scene. So what does he do? He goes to Greenwich Village and he learns everything about folk music, because that was really kind of the.
By the way, this guy's job sounds more interesting, no offense, Bobby, than just the OTC microcap analogy. You listen to all of Bobby's podcasts. But
there's
I think
so
I picked the wrong career. Anyway.
Yeah, well, there's so many parallels. So he's in Greenwich Village and he's rubbing shoulders with all these hippies, and he's learning everything he can about the music scene. And he signs this Carolyn Hester, singer-songwriter. She had a halfway decent career, but like during one of her recording sessions, she had this kind of tall, skinny, stinky hippie that had a guitar and harmonica in the recording session. And John thought to himself, he's like, who is this guy? I see this kid and with this hat on and this harmonica, and you didn't really play it well, but he's like, dude, this is going to be the next hit. This guy is going to be the greatest musician. And then so, of course, he signs this guy and everybody's saying, oh, you're making the stupidest mistake in the world. And then he's like, I just have a hunch. And so, long story short, kid's name is Robert Allen Zimmerman. You're like, who's that? It's Bob Dylan.
Bob Dylan.
And so he signs Bob Dylan before anybody thought anything of this kid. Bob Dylan has, sells 10 million records by like 1966 and then like 120 million by like 2008. Of course, that's it. But I think what John Hammond did and how he thought and how he, found, developed his hunch for talent, I think is the epitome of what every investor should do. So I'll just kind of boil it down from there. So what did he do? He was turning over more rocks than anybody else. He was in, the specific industry, or he was in the specific genre. He knew everything about everything in that space. And he knew, he went to every single rehearsal. Like I said, he knew everything happening and he had to listen to like trash, garbage, lots of it. But eventually, and of course he, since 14 years old till, even in his 50s, he's listened to so much talent, he can immediately, his pattern recognition for talent is just ridiculous. And so he's built up this pattern recognition database in his mind. Another thing he had FU money and attitude. Like, he didn't care what anybody thought. He knew what he knew because he just really understood, you know, what a great musician was and what audience wanted. And then the last thing, like attract like. So he himself, you know, Ian and I have written about Intelligent Fanatics. He's an intelligent fanatic himself because he's built up. He knows everything about music, you know, in a specific space. And he's got, you know, really high level of detail that he goes about. He knows everything about everything. And so when he finds somebody similar to him, it's like looking in the mirror. You just, you know it. So I think those are some of the takeaways. So it's really building the foundation for understanding. And so, you know, for me, it's business is people. Leadership is the rarest commodity in the world in terms of great leadership. And then you have to flip over more rocks than anybody else, build FU money and attitude, and really just become, you know, who you want to invest with. And then you just look for yourself. It's easy as that.
Marcus, let me just ask you a question. I'm curious. Do you talk to management at some point in your investment process? And how much does that come into play, especially with these microcaps and nanocaps, right? You do have access to management many times.
Yeah.
So I was wondering whether that's something that helps form your basis when you're looking for great companies.
Yeah, well, I mean, I'll be honest, like for me, management's largely a negative screen, you know, like because it's rare. Every now and then you come across really strong management teams, but in this segment of the market, like Sean's describing, but more often than not, it's a negative screen for me of like someone who's prudent, who, you know, is more of a business person than a salesperson, et cetera. You know, I've been thinking a lot about value versus growth recently. It's like this big theme that everyone's talking about right now, and a lot of like finding early situations like connotates, you know, growth investing, and I think probably your Expel situation is. But like I'm usually on the, you know, value margin of safety side. Sure. But then it's like if something like turns to becoming a growth stock, that's where it becomes you know, like the potential for a 10 or 20 bagger, where it goes from, okay, this is stable business at a low multiple with a reasonable management team. You could see it double from here. So I mean, that's kind of how I think about it. I mean, I think it's also easier to screen for ideas with a value mindset than a growth mindset, because better results probably come from identifying, you know, high growth, like the next Hammond, et cetera, you know, but it's harder to like actually screen. And so, I mean, I'm usually doing like capital IQ screens for, you know, companies that trade under 5 times EBITDA. We should put in the show notes the link to the FINRA new OTC stock page. I can email it to you, or you probably have it, Bobby. But I mean, like I've noticed, I've started following that in the last year. And one thing that I've like to participate in is when companies go bankrupt and they come back out. There's this like 30-day window where they show up on the FINRA page, but the equity is in the hands of the old lenders, and there is selling pressure at that point. So like Tuesday Morning is a retailer that came out in January. You know, you could buy that at you know, I don't own it. I did a while ago. You know, you could buy that at $1.50, $1.60. You could have put hundreds of thousands or maybe even millions of dollars into the stock at sub $2 a share for the first 30 days. So like super meaningful to me, but not meaningful to like an institutional investor. There was an institutional investor would have looked at it at that point and said, there's no liquidity here, I'm moving on. The stock's now close to $3 a share. And it wasn't that hard to just look at it and tell that it was really cheap. I mean, they cleaned up. All these bankrupt companies get kind of cleaned up in bankruptcy, and then they come out. And I think, you know, so that's not like the next 100 bagger. It's not the next Excel. And maybe from that standpoint, that's not the topic here, but it is getting in early. And, you know, if you wait for someone to write up to, you know, in that first 30 days, it was probably 3 weeks in, all of a sudden a write-up showed up on Seeking Alpha. and actually a small brokerage firm initiated coverage a few weeks in, and things kind of just stabilized, and it went up, 50, 60% in a few weeks. And, there's probably one new bankrupt stock out a month on average, and you can kind of like recycle your money into these things. I don't want to make it sound easier than it is, because they're not all good, but that OTC newly issued securities on OTC is a good place to look.
Yeah, actually, and it's an interesting question, because I think there's actually a way to merge both value and growth when looking for great companies, which is that sometimes there's a transition point in management. You have an old management team which is underperforming, and you bring in someone new, and there's a period of time where a lot of investors really don't want to make a move, but you're really starting to see the glimmer of some like truly superb management. And I can think of like Ryan Pape at Expel. I think of Renee Gorham at Bioscience. I can think of the management team at STK, and of course we can even think of mega large caps when Apple came back, right? When Steve Jobs came back. So, and sometimes these stocks are priced. I mean, they're turnaround situations in many cases, so they're priced very cheaply. But you really have that to go from a mediocre management team to a great management team. That's what sometimes is like you got that really like the supercharged possibility for the 10 bagger or even higher, right? So those are and they don't screen very well, but they scream value, right? And I like to sometimes look for those possibilities when you have a management team. Even I own all of those stocks in some various degrees, and even one more recently is like Galaxy Gaming that I have a position in also, right? You have a change in management, you have a lawsuit. A lot of people just want to push that stock away and say, hey, I don't really want to touch it, and things get resolved. But sometimes you have this great underlying business, a potential for a great underlying business. It just needs to be in the hands of the right manager. So those are, I think, really delicious opportunities to investigate if you're looking for that, getting that great company early.
How do you actually find it though, Jason? Is it through, what's your equivalent of the jazz club and wherever that was?
And I bet, and Sean probably could add this too, but these people who, after a while, and it takes a little bit of time, right? And it's you almost have to be let into the club before you get to go into the secret room, right? But you start building a network of friends that you share ideas with and who share ideas with you. And a lot of times, these like weird situations, like I just don't understand them, right? Or my friend doesn't understand it, but one of us understands, sees that little glimmer of like special in it, right? And they can explain it to you. So part of the, I think, the process as a investor is to build a network of other fellow investors to bounce ideas off of. And I think honestly, that's probably the most powerful way to discover a great company early, is to develop that wonderful network of friends, of fellow investor friends that you can investigate things with.
Yeah, I'd like to add on to that. And I definitely agree. We're having that network and having other different minds being able to ping off different ideas and different experiences off of each other. And I think Meredith Brill really elucidated and made that a really good word or term that she used, and it's mosaic. And I think having a group of investors helps you be able to piece together different parts that you might not personally be able to contribute yourself. And so, for instance, going back to the Expel example, I kind of have all of this kind of cultural / leadership kind of, piece of the puzzle. And then Jason has another piece of the puzzle with valuation and lots of other different aspects that I was able to glimmer, insights from. And then you have Meredith, who has like the background that helped during like the IP lawsuit. And then you have so many other people, I can't really think off the top of my head, but they bring in so many good insights that I wouldn't have thought of merely by myself in isolation. And so I would say having that group or network of individuals and just being in, going back to the analogy with John Hammond being in every jazz club, it's for yourself, you need to be in every microcap space where people are lingering, talking, chatting, and then being able to, hear what people are saying, listen, throwing off your ideas, and then you're able to really start to know what is happening right now.
Agreed.
Also,
Actually, oh, sorry, Jason.
is that I think you also find, and it doesn't necessarily happen in microcaps as much, but in some of these other great companies, like if you see a Home Depot really take off, right, or you see a MasterCard take off, or you see Walmart take off, there may be an opportunity. Sometimes it's a big enough market for someone else really to be successful too, right? If the economics are good, right? For a Walmart, there may be a Target, right? For a Home Depot, there may be a Lowe's. For MasterCard, there may be a Visa. So for Chicago Mercantile Exchange, there may be ICE. So I think there's ways to if you do see something that's great, doesn't mean there's not more great in that same area.
Right.
Yep. So I couldn't agree with everything that you just said. By the way, I couldn't agree more with trying to be everywhere where investors are chatting about these companies. I mean, I just sat in on a Clubhouse chat yesterday where they were doing stock pitches, and I found it just so cool. I really enjoyed it. Just that platform, that it was live and just kind of talking through ideas. And it was like, it was taking that, going to the bar meetup experience, and you just can play it on your phone. Like I had my headphones in, I was doing busy work, and I could just listen to, actually, I knew the stocks for years. So it was really cool.
One more name I'd just like to mention, which I don't own, but just for another example of like when management changes, and I'm not saying it's a great company, I'm just saying it becomes a more perhaps investable, at least worth investigating. It's like a company like Charles & Colvard, right? Had a change in management. Yeah. Looks like they're becoming more efficient. The stock is actually performing better, though in the background of a happy market. And I think actually they're going to be at the Planet Microcap Showcase, if I recall.
Wow, look at you giving a little shout out.
I'm doing all the work for you,
Bobby. You're doing all the the event promotion that possible. Yeah, no, I mean that's an interesting one. I can't really, because I actually interviewed Suzanne quite a bit, And,
yes. I'm just saying.
I haven't even interviewed new management yet, so I'm actually looking forward to doing that at some point soon. And are you a shareholder, Jason?
I'm sorry.
Are you currently a shareholder of Charles &
No,
Colvard?
I'm not a shareholder of Charles & Colvard.
Gotcha. Well, one thing I wanted to actually get back to, and it's going back to the John Hammond. I thought that story was really quite apropos for what we're talking about here, because you can think about that story both from an investor perspective and also when you're evaluating management. The whole time when I was hearing that, Sean, when you were going through it, is I kept thinking to myself about the new question that I ask most CEOs on when I do interviews with them is, I always ask them their background, especially if it's the first interview, but I've changed it up where I'm like, I hear more about the story, and I'm saying, well, I have to imagine you must have some experience doing so-and-so thing and doing what you're doing. Like I just did an interview, I remember, with a company that is making investments in like ideas out of tech transfer stuff. And I was like, oh, so you must have experience in building these small companies or taking these ideas to the next level. And of course, you said, yes, actually, I do, because I've had 3 exits, and now we're doing this. So it's interesting that was one thing I kept thinking of when you said that was, just when you're talking about people and culture, is really focusing on, especially when you're trying to find these companies early, is whether that management team, whether they're the founder CEO or the new management team coming in, if they actually have that experience doing some of these things.
Right. And you can also get an idea of how they think about leadership, how, what their vision is, how they communicate it to you, but you're able to talk with employees, potentially, or customers or whoever else, and you can really get an idea of how the founder CEO or the new CEO would be, how they actually communicate in reality. And so
I mean, there's so many examples. I mean, I was just watching the Blockbuster documentary the other day where, they brought in the Taco Bell guy, and we all saw what happened when the Taco Bell guy came in. And that's not to discount his success at Taco Bell, but, didn't so much work out with Blockbuster, right? And I mean, that's on a much more massive scale. And when we're talking about micros, I'd say it's even more important, especially with all the interviews that I've done over the years, is that the real guys and people have they had a long career. Long, that's not fair. They've had at least some experience in that area prior to becoming that CEO, or they were the founder CEO working at it for 5-10 years before then the company went public, and they know everything about the company inside and out. But Marcus, I mean, what do you think about this? I know you say you don't necessarily screen for management, so like when you think about management, especially since being on boards, I mean, I think we might have talked about this a little bit on our individual interview, but what are some things then that you do look for if you are to consider management, if everything else does check the boxes?
Well, I mean, like I said, it is usually for me a negative screen, and by that I mean it's something that would disqualify an investment, but not get it's not typically something that gets me interested up front. Like I'm interested on other characteristics, and then if you have the wrong management. But I mean, I think that high management ownership correlates to successful outcomes and like smart share moves in the interest of shareholders. Liberated Syndication is an interesting stock, and I don't own it. I did in the past. I don't know if these guys have followed it at all, but I mean, that's a company that, so like, I don't know what platform do you host on?
I use their competitor.
Libsyn?
No,
You use a
I
competitor.
use,
Okay.
I use
Well,
Podbean.
so Libsyn was like one of the earliest podcast hosting platforms. So like they're not competing with Apple Podcasts. They're who you, if you want to start a podcast, you sign up with them. I think it's like for the entry level one, it's like $6 a month, but then it goes all the way up to like probably hundreds a month, and then they'll help you with advertising and take a cut and things like that. I mean, that was a company that had pretty bad management, about as bad as it gets. Like borderline. Anyway, I don't want to impugn anyone, but I think if you Google it, you'll get the point. But so that's like why I look at it as like a negative screen. Like I ended up investing in LSYN, but the biggest negative was management, and then actually a really small activist fund, did a campaign and change management. So like that, and that stock went from it was originally spun out of another company that was in bankruptcy. And it came out at like 40 cents a share, and it's like $4 a share now. But it's a high growth company that, but again, I found it because it would show up on the under 5 times EBITDA screen, even though it was growing 20 or 30% a year and is in like one of the best high growth industries out there. If I'd looked at that and the CEO was, an ex-executive from Spotify or something, I mean, that thing would be trading at 10 times revenue, but it was like the opposite. But even it was such an extremely undervalued stock that you could get over, the folks running the company. So that's what I mean by negative screen.
Gotcha. By the way, my quick story on Podbean versus Libsyn is, in all fairness, this is not a typical consumer trend of mine, but I remember when I looked up podcast publishing, Podbean was the first one that came up at the time. This is back in 2015. So like, I guess they just paid a little bit more on the SEO side to get started.
Right.
Also, it said Podbean, like the name in it itself. I was like, Liberated Syndication versus Podbean. I'm gonna go with Podbean.
There was a time when Liberated Syndication, I think, was like 90% market share. And I mean, it kind of gets to like management. Like if you had the right people running the company, we'd be talking about Liberated Syndication, not XPEL. And I mean, it's still, I think the people involved now are top notch, and it's probably a pretty interesting situation still. But competitors came up, and I think there's a company called Anchor that I think Blueberry. So there are a few now, and they kind of like had this early move in this great growing industry, and I think they're going to do great. But like they lost a couple years, I think.
Yeah, I think there really is like sometimes with these smaller stocks, right? There is a window of opportunity in a market, and and I don't own the stock, but I think of like Jones Soda, and and they had Jennifer Q, I think, who I think was for a while was a CEO and very highly rated, very highly considered, but it was just she came in at a time when like even if it's real sugar, but that wasn't where the market was going in drinks. And sometimes even if you have a great management team, if there's just so much headwind in your business or your industry, even a great management team can't overcome that. Or and then it's a chicken and the egg thing, right? What makes for, are we recognizing great managers because partly they're in a great industry or a growing industry, right? It's tough to separate them a little bit. But I just want to make one point, Bobby, is that sometimes and I'm sure Sean, you may have some thoughts on this too, right? Like we see these threads on Twitter that like, tell me the next 100 bagger, tell me the next 50 bagger, right? And there's like 60 people who have like responded with these ticker symbols, and you start looking through these ticker symbols, hoping to find the next 60 bagger, 50 bagger, and you find these companies, and these people believe in them, but they do like $150,000 in revenue, and they're losing like $6 million a year, right? And they obviously going to need to do like 16 secondaries in the next 16 months. And you wonder, I mean, people sometimes think like to find the big next great company, you got to like buy a lottery ticket. And great managers don't work in lottery ticket businesses, at least not for long, because who the heck would want to work in a company that's like on the verge of like blowing up, time and time and time again. Right. So great management teams, great companies find a way to stabilize the business, put together at least a decent balance sheet, the kind of business where someone who has like a family and kids would actually want to work, right? Who has responsibilities. So I do caution anybody who's listening, if you like have a portfolio of like lottery tickets, thinking that's going to be like your the way to the lifestyle of a rich and famous type house. It ain't the way, man.
And I'd just like to add that, thank you. It's like with investing, there's so many different ways to skin a cat, and there's so many different genres of investing. And I think what we're talking about right now is a very kind of specific style. So, looking at the management, looking at, what tailwinds are there. This is just one way to look at the next great business, because there might be other businesses that you might be going through something that's slightly differently. They might have different economics happening that still could be another great business. So just really, again, adding on to your point, Jason, that there's so many different ways to invest in this. We're just kind of talking about
there's my way or the highway. That's it, Sean. That's it. No, you're right. You're absolutely right.
Very cool.
Or just going back to the music analogy, there's 10 different ways to play just one type of blues. There's just so many different ways, and it's all music, just like this is all investing.
And you know what? I'm sure John Hammond had quite a few that he, quote unquote, missed. Or saw.
Not really. He's like the Warren Buffett of music back in the.
That's a great point, Sean, because the great ones, they really don't miss as often as you think they would, right? The great ones have such a, we talk about slugging percentage, but they connect often, and they wallop the ball too. So right. that's like a tell for like a great management team, because they just don't screw up. They don't screw up.
And but we could move back even further and kind of delineate what makes them get to that point. And of course, that would be another, podcast show on that topic. But
we got time. Marcus doesn't have a hard stop anymore. Let's just keep going.
At some point, I'd love to. I'm probably the only person that doesn't really know the Expel story. Like, I know, all I really know is it was, like 100 bagger or something like that. I'd love to hear that. But like, just first one observation is like, if you're getting a 10 bagger, the following has to happen. I mean, like, let's just say you have a stock that's trading at PE multiple of 20, and that multiple stays flat. To triple your money, you have to grow the earnings at 25% a year for 3 years. Then to get up to 6x, you have to grow the earnings at 25% a year for another 3 years. So you're basically, to get the 10x, if you have a constant multiple of your earnings, you've got to grow your earnings at 25% a year compounded for 9 or 10 years. Like, it's not too many companies can do that, and then the 10 baggers that I've seen, and most of them I participate up to like 2x or 3x, and I sell too early. I always do that. Is some like massive valuation change on the current business. So like I mentioned mechanical technology, like they were like 6 times EBITDA and a market cap of like 7 over the summer. And then all of a sudden the market decided, because they're involved with Bitcoin mining, they're worth 90 million, you know? And so, but the multiple is now, instead of 5 times operating cash flow, it's now 20, 30. I don't know the exact number. I'd have to look it up, but it's in the, you know, in many, many multiples of where it was valued when I started looking at it. And so I was just curious on like Expel, like, I mean, it all boils down to how fast they're growing their earnings and how the market's valuing those earnings. And I haven't seen too many 100 baggers in my life, but I'm interested in how like those two variables played on that investment. And maybe I'm mistaken that it was a 100 bagger. That was just my impression.
Jason,
I
do you
think it's
want
a 100
to
bagger, depending on what you get in, right? And so much. I mean,
Oh, right.
you
Yeah.
can have a 10 bagger, you can have a 100 bagger, and still do very, you know. But some people bought Expel at $5. Some people bought Expel at 50 cents. I think the last time I was on your call, Bobby, like 2 weeks ago, was at $60. I'm losing $1 a day talking to you. In Expel, by the way. So I hope you're bad juju. You are bad juju. But you know, to get back, Marcus, and I think with these very small companies like we're hunting, the nano caps, micro caps, right? You can actually achieve more than that 25% compounded growth in earnings, because there's such tremendous operating leverage for these tiny companies.
Yeah.
So you'll see a situation where they, maybe even for a couple of years, they make 100% more, 200% more, right? And then they start going to that more, that 15%, 25% growth for a few years. And so you get that, you know, deservedly so, even though it may trade at a 20 PE, you get, you know, tremendous earnings growth plus some multiple expansion if it's truly a great business, let's say like an Expel. And you know, I owned MasterCard back in 2006, right? You go through some of those early conference calls, and you know, the operating margin was much smaller. No one was thinking it was going to get to the operating margin it had now. And that was a company that, you know, everybody has in their wallet now, and everybody had in their wallet back then, right? So, and that's actually another way to identify some great opportunities. And Peter Lynch even referred that like demutualization. When you see something like demutualize, whether it's the Chicago Mercantile Exchange, MasterCard, Visa, you don't see it as often anymore. Those are usually some fantastic opportunities to invest, because the company's not being run really for profit until it's run for profit.
And another thing to kind of think about is the amount of some of these smaller companies trying to invest, you know, in SG&A, and how that might be affecting, because of course there's many different ways to invest in operational cash, you know, through CapEx, but there's also a lot of ways to do it above the income line, where that might be really, you know, masking the amount of profitability that a company currently would be at, but they're trying to invest, you know, sales team, you know, in 5 years, it's going to start pumping out a lot more money. And so that's one thing that I was really, that helped me try to think about a current valuation of Expel back in, you know, 2014, 2015, and trying to really fully understand what they probably should be making now if they weren't reinvesting as much money as they were. And then going back to the management and how they're able to incentivize, motivate, get all these, you know, pieces that they're investing into, these human kind of expenses. How will that really help the trajectory of the company in terms of earnings, gross margins, and revenues later, you know, 5 years down the road?
You know, another thing I wanted to bring up with you guys when it comes to finding great companies early is thinking about trends. You know, because it's one thing to do our screeners, you know, find companies that way, going to events, finding companies that way. But you know, one thing that we don't really talk about too much on here, that, or at least in a while we haven't really talked about, is forecasting certain trends that you see are coming, and then how to more or less find not just the companies within that, but then the great companies within that are trying to capitalize on those trends. So how do you guys think about that when it comes to finding these great companies early? feel free, anybody jump in.
Yeah, it's kind of case by case. I mean, it's like there are certain, industries that are very highly valued right now, and it, it, the stock I'll mention now, I do own, and I'm on the board of a Scientific Industries. Like they had, a pretty commodity lab equipment business, and then they had some intellectual property around something called bioprocessing, which is kind of like tools and equipment for biotech companies. And like when I looked at it, I didn't know anything about bioprocessing, but you see they're getting royalties from something, and then you see who's paying the royalties, and it's a company trading at 10 times revenue that is growing really fast. And so like that one I kind of stumbled into, and now they're emphasizing that area more, and it's the growth part of the business. But for me, like I don't start out top down. I go bottom up, and that's why like I'll look at something that's cheap and then say, oh, like that thing over there looks like it could be worth a lot. I mean, I mentioned cryptocurrency. Like I'm actually kind of not a big, I'm more of a gold person than a Bitcoin person, but it's hard to ignore that, crypto is something that the markets are valuing very highly right now. Just like bioprocessing, crypto, I mentioned like podcasting is one of the fastest growing media areas. So I didn't go out, I did own Liberated Syndication for a while. I didn't go out looking for a podcast company to invest in. But usually the stuff I invest in is kind of like boring, slow growth stuff. And then, like I said, you invest and then you get really excited if there's some upside thing that seems pretty sexy in the market today. That's at least for me. Sean and Jason, it sounds like maybe are more focused on, well, maybe more management than big themes, but I don't know. You guys speak for yourself.
Yeah, I don't really have anything with big themes. Just I guess seeing what is happening around me and just trying to take a guess of where a company might be within that space, and seeing if there is some type of tailwind behind it to really potentially help out with growth later on.
Yeah,
Jason.
I think what I could add is that sometimes there's with microcap investing in particular, right? You have companies which are doing very well in a niche, right? And the question is, how big is that niche going to grow? And so it's interesting when you see, like a company like Expel, not really devote very much money to advertising, right? It's a lot of word of mouth. A lot of people on who love cars almost seeking out the product, because it's been a very small percentage up until recently for just traditional marketing. So when you see like passionate customers, to me that's always intriguing, and you need to investigate more. And I go back, and I think I can't find the post right now, but I posted on Twitter before about how these analysts really underestimated how many Starbucks could be in the United States at saturation. Tremendously underestimated. And and we all know about coffee, right? It's not like coffee's been around for a long time. We all but to look at like how many Starbucks there are in Seattle and think, oh, there only could be a fraction of that in other markets, or oh no, people in suburbs won't appreciate coffee places, coffee houses like Starbucks, is sometimes is a potential opportunity for like further investigation. Because when you see passionate people in Seattle, or passionate people who with Porsches, they say, why are there not other passionate people around the country, or passionate people who own Subarus who may want some of the same benefits? And so a lot of times I think there's opportunities in stocks that you can't really model out very effectively early on, right? And that scares away a lot of investors, because they say, well, I can't model it. But you can sense, you can be roughly right? And you can sense there's some great possibility there. And so, yeah, that's, it's not necessarily maybe a theme as by what you mean, but I think it's a sense that there's a niche that has a possibility of becoming tremendously larger. And then that's a tremendous tailwind for a lot of these small companies.
And I'd like to add on to Jason's point that usually the microcaps are focusing on a niche and then expanding from there. And usually it's hard for an investor to see where the company's going. But if you're talking with the management, you can kind of get an idea, and especially the really talented ones, they're able to communicate where they see themselves getting bigger than their niche. So I remember when I was meeting with Ryan Pape and Barry, the CFO, I don't remember when it was specifically, but it was at one of the investor conferences. And I asked him, like, how are you guys going to expand out of paint protection film? And he's like, I've got a list of so many other products that I want to, sell. And through my study of Intelligent Fanatics or great business leaders, they start teeny tiny, and looking at retail, with Starbucks, or you're looking at Sam Walton. That's a little easier to conceptualize because you're usually starting with a small geographic location. You're just replicating. But with some of these other industries, it's a little bit harder to conceptualize, going from paint protection film to window tint, then now to like protection film for like interiors for cars, and then going from the ceramic stuff that you put on the outside of the car. There's so many different things. It's a little bit, like I said, harder to think about it. But the really talented leaders, they're talented enough to go from a small place and expand it. And they figure out a way to do that.
One more thing, Sean, is that one book that I always recommend people to read is like Blueprint to a Billion. And Sean, I think our friend Ian Castle also enjoys that book.
Yep.
And you'll sometimes find these tiny little companies who latch on to a bigger company that's growing, right? And I have, like, for example, some ownership in Galaxy Gaming, which is a microcap, and they're latched on to, they're riding the iGaming wave with their content on the back of Evolution, which is a very large iGaming platform. And of course, there's a big question, right? And I don't know how, it could be a 10 bagger, it could be a nothing, right? And that's the difficulty with investing early, is that how much of the value we're going to go to content producers, how much of the value is going to go to the platform. Will they have a lawsuit that has to be resolved and things like that. So it's very difficult. It's very different. It's always, even with Expel, it's easy to say, hey, it's gone up 40 times. Look what a genius I am, right? But honestly, I was a total moron in some ways, because when I initially looked at it, it was like $4 in like 2015. I said, forget it. This is car condoms. This is ridiculous. How many people want car condoms, right? And I actually bought a tiny little position, sold down half of it when I saw some like difficulty. And, it was the fact that it continued to go down, and the lawsuit, and I started investigating a little bit more, that gave me the opportunity really, and the interest to like really investigate it. But I may have missed out if there was no lawsuit, or if there was no microcap sort of bear market in mid 2015 onward for a while, even because it was at $4, and that still would have been a 10 bagger. So, a lot of times it's just finding, the stock finally hits our skill set that we can analyze, and we end up with a little bit of luck, right? Luck comes into play with finding some of these early companies, and we don't like to admit it because we're all fantastic investors, but there's a decent amount of luck to this game.
I'd say it's probably more than 50% of luck, just being in the right place at the right time, but having the courage is going to be probably the next most important part of going after the company, learning as much as you can, and then being able to buy.
Finding the company, 50% luck. Holding on to the great companies, I would say, is like only like 15% luck.
Right. Oh yeah. It's a lot more skill, a lot more courage. Yeah. So
I'm sorry, Marcus. I really want to throw it to you.
No, I was just about to joke. Like, I'm good at the part that's luck, and I'm bad at the part that's skill. No, but totally.
I like the luck. The luck part is, I live in Las Vegas, man. Luck.
Yeah.
I love luck.
So one last topic, before we let everybody go. We've been talking about the positive and a lot of the great anecdotes, a couple not so great that happened, but I really want to talk about, the imposter syndrome, or how we can identify the imposters where, you think you found one that's, oh, this is it, great company early. I don't think it's a lottery ticket. I think this actually might be a real thing and I should hold it forever. Here we go. I'm going to cost average up as it keeps performing the whole thing. So in your guys' experiences, what are some things that you've seen that have been clearly, okay, now I know what to look for as this is an imposter, great company early. Whoever wants to start. Sean, Marcus? Sean.
Kind of using my music analogy, it's pretty easy to see somebody's skill. Seeing a business's skill usually takes time to see how they execute, and then usually the profits is the yardstick that you're able to see if they're doing well. But usually with an imposter, say in music, they're just playing, what everybody else is playing. And they don't really put any of their own unique spin to it or style. And I think going to businesses, it's the same thing. And management, it's the same thing. They'll say, what you want to hear. They'll say, if it's, somebody who's managing money, they're going to, spout out lots of Warren Buffett or Charlie Munger. Or if it's a business, they're going to be, really salesy. They're just going to try to tell you everything that you want to hear to, sell, you to buy their company and become an investor. So I think there's a pretty, again, this could be a really big topic, but it's identifiable, just seeing somebody who's just saying something and, regurgitating, whereas somebody who actually really understands something, who's really an expert on something, really can add their own twist to it. And then when they're communicating to you, they can do it in such a simple way and concrete way that you're like, wow, I really actually understand this. And so I think it's applicable to businesses as well.
Absolutely. Marcus, Jason?
I have some thoughts, Marcus, but if you want to go first, it's up to you.
I'm happy to go first. All right. Yeah. So, I mean, the way I look at idea generation, like I mentioned, it comes at it from a margin of safety and like generally a low valuation relative to earnings or assets. So, I think the thing that's great about that is there's less downside than if it's, like the next mining stock or like a lot of people in the microcap world get attracted to like lottery tickets, biotechs or some mining situations seem like two of the most common. And so I usually like to find, like most of what I invest in are just kind of cheap stocks, but some do have this like lottery ticket element to them. And the situations where I lose money tend to be, and like Warren Buffett has written and talked about this a lot of like, at some point in his career, he moved away from, really cheap, bad businesses and into great businesses. And, I've been frustrated many times by just dead money, in a stock. Like the one that I have the biggest position in right now that's been frustrating for a really long time. I was about to say shout out to Nate Tobick for giving me this one, but I don't know whether to like, if that's actually a shout out. But I do think it's cheap, but it's just kind of has been dead money. And this has been like a value investor's graveyard, I think, for like a decade, is Hanover Foods, which I do own. And, it's so cheap. It's like trades at like 20% of net working capital, and they make like canned foods and stuff. So it's not going away. It's really cheap, but they just don't really consider themselves a public company. And I plan to hold that for a long time, but it's one of those things where you could wake up one day and like they sold to someone at above where the stock trades, or they pay a 2% dividend, but that's just such a bad opportunity cost. So those are my bad situations. And I think that's the good thing about value investing, is that you have a margin of safety. So it's, unless you got something really wrong, it's not going to go away. That's been my experience.
Let me tell you what I think is probably for growth investors, like the most dangerous imposter situation of all time. Okay, which is you've latched on to a great founder who's done a remarkable job taking the company from here to here, but for whatever reason, and you've benefited from that, and you give him a lot of trust and a lot of rope, but whatever it is, and usually because he can't build a great management team around him, can't go from here to here. And you end up giving this guy a lot of time and a lot of opportunity cost which has been lost because you're waiting for him to make the next step, to make the hires, to build the team around him, to move into ancillary platforms. And he or she just can't do it. And I find those situations to be extremely frustrating. And because you really like the person, you love what they've done, they've made you money, they just can't make you much more money. And those are very tough to identify. I mean, the crooks, the slime balls, the promo teams, the guys who give you like a 60-page deck that's a $2 trillion size TAM, those are easy to identify, right? It's the really good guys who just can't, they're AAA players, but they can't get to the major league. Those are the guys that really break your heart. And sometimes your wallet.
But sometimes you might be able to ask that and try to get an idea of what their actual motive is, because sometimes there are lots of people like that, and they're just happy being where they are, and they that's just the lifestyle that they want. But there are some of the other ones that are like gung-ho on just trying to make the biggest company, and they have the skills, the courage to actually build that team around them. And so that's one way to think about some of the people just to stay away from, is just being on the same page. Because if you want to make the most money out of your investment, you want somebody who has the vision to actually build the pipeline and all the business to get to that very big company. Because there are a lot of people that are happy just doing their own thing, or just being at a $10 million company or whatever.
Yeah, I mean, and that's a difficult thing, right? I mean, every management team is different, today and 5 years from now. They either will improve or they will get worse. They rarely just stay the same.
Right. Hey, Jason, how do you tell the difference between a management team that, like you said, is the AAA player versus the major league player, but let's say they're in a position where where it's taken them a bit longer, right? I mean, because there's some AAA players, right? You just use this analogy that they don't make they're like Luke Voigt, right? I'm sorry, I'm a Yankee fan. They're like Luke Voigt, who, no one, I don't think anyone, thought back when he got drafted would eventually be the home run leader, and even though it was a truncated 2020 season. So how do you identify the good management teams that have been there, they've made you money, they've hit a little bit of a plateau, but maybe just trying to tell the difference between they're just waiting for the right opportunity to take it to that next level, or just they have plateaued completely?
If I knew the answer to that question, Bobby, I would still own my Liat, right? So.
Well, was that management though? I don't think that was so much management as it was.
This is the problem when you analyze mistakes. It's so hard to figure out what exactly was your mistake, what was bad luck, what was just timing. So everybody likes to say, "Oh, you got to pay your tuition, learn from mistakes." You know what? Learn from success. It's so much more fun. Learn from success. The worst thing, and so many people do this, they learn the wrong thing from their mistake, which is like another mistake, right? It's like.
And it's just, imagine the amount of time that you would waste learning other people's mistakes and embedding that in your head, while you could be learning the right steps to take and then acting on it so much quicker. Right. And so it's like, think of like a maze, and there's so many people who have done significantly exactly what you want to do, and they've done phenomenally, and they're already at the end of the maze, and they already have the path there, and you can just pretty much retrace it.
Just to get back like with Marcus, I mean, Marcus is a little bit more, I sense, like more of a just a traditional value investor, right? Focusing on that margin of safety, probably looking for lower PE stocks, while Sean and I are not like that as much these days. And we've benefited from this tremendous decade-long tailwind in multiples, right? That makes some of our growth investments look, which would have been very good, look like genius moves.
Right.
But they may not look like genius moves. Well, in another 2 weeks, when I go on another podcast, when the Expel is like $35, it's not going to look like a genius move. But but I mean, really, right? There's multiple contractions sometimes too. And you have to be able, as an investor, to figure out how much of what you did was really picking the right stock, picking the right team, and how much of it was just, in some ways, kind of luck. And it's really not an easy thing to do.
I mean, that's why we're in business, right? If as Ian, I think, would say in a couple presentations, investing is hard.
Yep.
And I think that might be a great place to end it right there. So let's get everybody's final takes, where people can go and follow you on social media or websites. So Sean, love to get your final take on this topic and where people can go and follow you.
Yep. So like I said, I think one of the greatest superpowers, if you're looking for the next, Walmart, the next Costco, the next Southwest Airlines, is to really hone in on the what's knowable. And I think that part would be the people portion, that starting with the leader and then going down to the culture they're creating, the team that they're building. And with me, like I write my own stuff, like on Twitter. So my handle's Iddings _Sean, IDDINGS_SEAN. And I write stuff I relaunched like a new blog, thewoodshed.com, and shed with 2 Ds. And I just, pretty much kind of going back through Intelligent Fanatics kind of stuff, republishing that, and, writing up new stuff and following how I'm applying some of the things that I've learned to my businesses.
Very cool. And by the way, he's got some of the most epic threads out there covering business and investing, and keep doing those. I love reading the long Twitter threads. You just end up, you think it's so quick, but then you end up like half hour later, oh Jesus, it's on the 60th tweet, and I'm connecting, but it's fun. I love it. So Marcus,
yeah, this has been fun. Yeah, I guess final thought. Yeah, I think everyone evolves as an investor. So, and in some respect, like the holy grail is like combining value and growth, and so I've like stumbled upon a few really high growth compounder type situations, and I tend to sell too early. So I like I said earlier, so I'm trying to evolve into kind of, focusing in on, the value stocks that have some of these attributes that Sean and Jason have talked about. So it's kind of, that's, I guess, my focus. And I think I learned some stuff from this conversation to help with that evolution. And I'm on Twitter too. It's at Marcus Frampton. And I also put out some writing and stuff. The link to like my blog that I write about over-the-counter stocks is on my Twitter. But it's microcapletter.com.
Very cool. Jason?
Well, you can find me on Twitter at 8track180, EIGHT track 180, or a MicroCap Club, or at Hudson 215 Capital. Always a pleasure, Bobby. And I just want to say one more last thing we didn't talk about. And even if you aren't a MicroCap investor, even if you don't talk to management, sometimes you can read like a letter, like Constellation Software, like their chairman, they're like, it just blows you away. And sometimes people, I mean, they literally just print PDFs telling you, giving you the blueprint about like the future and how great they are. And you just are, why I haven't owned more of that stock, why everyone here hasn't owned more of that stock. This goes to show you how we're still learning and trying to improve all the time. So, sometimes you don't, opportunities are like everywhere. You just have to put a little bit of work in them and find them.
Yep, I couldn't agree more. I would also add in transcripts, conference calls, just, anywhere that if you can't personally get, if you have a personality that likes to talk to management but can't get a hold of them, there is a lot more stuff out there. maybe not all the ones that Marcus looks at, all these OTC dark stocks, but a good amount of these micros do tend to do conference calls and stuff like that, have transcripts. But with that, gentlemen, this is an absolute pleasure. Thank you so much for joining on this episode of the Investors Roundtable, and have a great weekend. And I look forward to seeing you all next week. Not you guys specifically, if you want to, of course, but this is like the royal we. Anyways, okay. With that, thanks, guys.
Thanks,
All right,
Bobby.
thanks, guys.
Thank you.